I'd like to talk to you about portfolio theory and specifically structuring a portfolio to take advantage of what I think is a reasonably strong option that people should consider instead of what normally goes into this portfolio. And what I'm referring to is modern portfolio theory to start, and I have to describe what that is. In 1952, Harry Markowitz, an American economist, created this concept, modern portfolio theory, which won him a Nobel Prize. The theory is simple, the concept is simple, the practice not so much. But the theory is you put together various assets with various risk profiles. The idea is you can quantify and qualify how risky this particular investment might be versus that particular investment and so on. Put them together to give you the most reasonable approach to enhancing the growth of your investment portfolio overall. Now, we know, we've all heard that when you're 25 years old, you should have maybe 75% of your money in stocks and 25% of your money in bonds. And then by the time you're 65 years old, you reverse it. 75% of your money in bonds, 25% of your money in stocks. Now, why is that? Well, because we know that the volatility of stocks might look like this. It goes up a lot, it might go down a lot, and we know over time all of these things will happen. It's all over the lot. And we also seem to know that bonds do this. They're much more reliable to stay somewhat close to the economy and how that performs and whether interest rates are at 4% or 7% or 3%, but this volatility versus this volatility. So the idea of combining the two gives us less volatility overall because we've taken, for example, let's say half the portfolio goes into this and half the portfolio goes into this, as opposed to everything doing this. Simple. Now, a quick story to further explain that. Young couple living in an apartment, both employed, doing well, and they have a dream of starting their own business. They're out strolling on a Sunday afternoon, and they come across an empty storefront. And they decide this would be the perfect location for a donut shop. So they go ahead and rent the place, and then they put together some cash, and they start purchasing all that they need. They get the showcase, they get the coffee maker, they get the coffee beans, and so on. At the 11th hour before opening the business, one turns to the other and says, "We must be crazy. Why would we both quit our jobs? And this total risk. What if it's unsuccessful? What if we can't pay the rent? Here's what let's do. You go ahead and open the shop. I will join you weeknights, weekends, until we know it's up and rolling. When it looks to be successful, I will quit my job. But in the meantime, I've got an income stream. We're going to pay the rent. We'll have food. We'll have a roof over our heads." That's important, right? Well, what that really explains is, in its simplest terms, portfolio. Stocks is I'm taking the risk on the store, on the shop, and the constant income, that's bonds right here. Constant income stream into the portfolio, so to speak. So what we're talking about is when you put money together for, let's say, retirement, for down payment on a house, whatever, or you just simply want to grow your wealth and you go to a broker-dealer and you start investing in whatever it is you invest in. The idea is, what do you do to create a portfolio that suits you? Well, you're supposed to determine your risk profile to see what kind of a risk taker you might be, and people think that when they're 25 years old, that automatically makes them risk prone and so on. Funny thing though, in my experience over the years, what I've noticed is that people, when they reach, they seem to be more evidently predisposed when they're 50 plus years old to approaching what I would characterize as panic mode. Now, that in simple terms, they know they're approaching retirement. Now they're getting anxious. Now they'd rather retire at 62 than at 65, or maybe they think 65 is too soon because they don't have enough money. But whatever, they start to really center on the idea that not enough cash, therefore not enough income to support what their lifestyle should be when they retire, what they want it to be. They think, and most investment advisors seem to support them on this. I don't understand how they manage to do it. But most investment advisors seem to think, yeah, well, you know, stocks perform, and over the last 15 years, we've seen the stock market go gangbusters. Well, over the last 15 years, we've seen a very, let's call it a mutant market, where the stock market can't seem to do any wrong. Every time it seems to soften a bit, you pile in and it just goes up. That can't last forever. It will not last forever. Nothing goes straight to the moon. You know there are disruptions in various industries and various companies, and therefore their stocks cannot go up forever. Simple. But what happens when these people approach panic mode? Well, here's the telltale sign. The portfolio is going to have, based on my experience, somewhere between, and I'm serious about this, it seems to have somewhere between 0 and 7% of the portfolio in bonds, something to modify the volatility of the portfolio. Does it make sense? If you knew the market was going straight up, yes. If you don't know the market's going straight up, or you suspect it might go down, and over the course of the next, how long into your retirement, how many years will it be before you're 100 years old? You know the market will go down precipitously at some point. Maybe more than one point, maybe many points. So what do? You put together a portfolio, and the way you would do it is you would determine with your advisor the percentage of the money that should be in stocks, mutual funds, whatever your bent is, and the percent that should be going towards something to modify that volatility, like bonds. Now, how do bonds work? A bond is an IOU. You're lending money to the issuer of that bond, IBM, Ford, General Motors, whatever. But you're lending them money, and they will in turn pay you an interest rate, interest income. So let's imagine you buy a $1,000 bond. That's the smallest round lot, it's called. And you're promised a 5% interest rate. That means for every $1,000 bond that you own, $50 per bond per year. Now in the United States, corporate bonds, municipal bonds, treasury bonds typically pay interest twice a year. So a $50 per year income becomes $25 every 6 months per $1,000 bond. What happens if you go to buy a bond? If you go to buy a bond, you're typically looking at what are called yield to maturity calculations, YTM. What is a yield to maturity? Yield is the return on your investment. It's a suggestion as to what your money will give you at the end of that period, whatever the period is, 5 years, 10 years, 20 years. Maturity is that period. Will the bond mature in 5 years, and 10 years, and 20 years, and 30 years? That is in combination, putting money in, seeing a return based on what happens along the way, and getting your money back at the end of that period. So if I buy a bond with a 5% interest rate, also called the 5% coupon, and I assume 5.3 yield to maturity, that means I'm buying the bond at a slight discount. That's where that 0.3 comes in. But every 6 months, I'm going to get a check for $25. 5% interest rate, $50 per year, $25 every 6 months. Now, when the computer determines your yield to maturity, it must make an assumption. And the assumption is what you're going to do with that $25 check, the $25 payment. And it makes the following assumption. It assumes that that $25 payment gets reinvested at the original investment rate, which it just calculated. It made the assumption, which allowed it to make the calculation of 5.3 yield to maturity. $25, therefore, in the computer's mind, gets invested at 5.3%. And then the interest on that, when it gets invested, also gets invested at 5.3%, and so on, and so on, and so on, forever, until the end of the period for that bond, 10 years, and so on. The reality is, when you get a payment of $25, think of it in these terms. Can you get someone to pay you 5.3% for $25 today? Not at my bank, not at my broker-dealer. $25 wouldn't buy a bond. And even if it would, 5.3 without fail, doesn't happen. So the idea that bonds are a perfect vehicle in which to calculate a yield to maturity is fiction. The yield to maturity is necessary. It is absolutely necessary to be able to calculate yield to maturity. We have no alternative. We can look back at what happened. I paid this, I got that in return. But looking forward, I have to make assumptions. And looking forward with those assumptions, if I assume 5.3%, 5% interest rate along the way, I must assume I'm reinvesting at 5.3, 5.3, 5.3 every time. Doesn't happen. So what's a better way to ensure that I'm going to not only have to reinvest on my bonds every 10 years or 20 years or whatever, whenever the bond matures, I get my money back. Now what do I do with it? new bonds. Well, if I have a constant vehicle, a constant growth vehicle, that does not require that I worry about reinvesting the money and does not require that I assume certain rates along the way, they may fluctuate inside that vehicle. But do I have to worry about what kind of compounding I'm going to see, if there's compounding at all? If I have to reinvest at 5.3 every 6 months, that's not compounding. That's growth. And it might be feeble growth at that, because my $25 check might only be good enough to buy a sandwich, or maybe 2 sandwiches. But the idea is it doesn't go to reinvesting along the path that I anticipated available to me. It doesn't happen. If I have a surrogate, a replacement, something better to replace those bonds and to enhance the growth of my stock side, assuming it grows, or to offset losses if there are losses, that's what it's supposed to do along the way. So enhance, offset, and grow along the way regardless with compounding. What is that vehicle? And the answer is, don't shut me down on this, listen to the end. It is participating non-direct recognition whole life insurance from a mutual company, and the company has paid a dividend without fail for a minimum of 100 years. Okay, now let's look back. What does that mean? If I buy a whole life policy, not universal life, whole life, if I buy a whole life policy from a mutual company, I am technically now an owner of that company. Tiny, but an owner nonetheless. Participating in that description, participating means I participate in the distribution of profits at year end at the company. I get it in the form of a dividend. That dividend increases the size of my life policy, increases the size of my cash value. What about that middle part of the phrase, non-direct recognition? Well, if I want to use cash along the way while I own that policy, I don't have to sell pieces the way I would with a portfolio with bonds and stocks and so on, even if I have enough to leave a portfolio alone. Here, what I'm doing is I'm setting up what's called permanent capital, meaning my investment stays solid until the day I die. Not bad, but I use my policy and the cash in it as collateral so that I can use another nifty phrase, other people's money. In this case, the insurance company's money. But when I do that, I'm borrowing from the house, not from the policy, and the policy grows in full. So, non-direct recognition, what does that mean? When the company issues the dividend every year to pay me, the computer is given the rate. It looks at my policy, looks at last year's payments, last year's growth, last year's all the factors, and it determines what my dividend will be, and it pays me. If I have a loan outstanding, if the policy was a direct recognition, my dividend might be smaller than it might otherwise be. If I have a non-direct recognition policy, which is what I'm suggesting, the computer sees the loan and doesn't care. I get full dividend, full growth, and I use that until the day I die. So overall, people tend not to understand the use of bonds in a portfolio. They tend to panic over the age of 50 toward retirement and think that that's the only way they're going to make money. And based on the last 10 or 15 years in our stock market, the index rates and records set have given people, I believe, a false sense of security. You know that in the next 20, 30, 40 years, there are going to be some downdrafts. Can you afford to see that when you're 80 and 90 years old? I think not. And generally speaking, and specifically speaking, the approach people use with bonds has been dismal. What they should be doing is making sure they have some stability in their portfolio, and I can do better, and you can do better, and why don't you do better? And the way to do it is to grab something that has been poo-pooed by some of the talking heads on the web or on TV. There's nothing wrong with life insurance from participating, a non-direct recognition, whole life policy. There's nothing wrong with giving yourself the opportunity to at least look into this. I'm not selling you anything right now. I'm telling you to look into it. It's to your benefit.